Good afternoon and welcome to our webcast on the proposed changes for taxes in Mexico. We will be discussing this subject for approximately 1 hour and we'll have 15 minutes for questions and answers. You will see on the right-hand side of your screen there is a tab that will open for you to ask your questions. We suggest that you send them during the course and they will be addressed in the Q&A session. The recording of this webcast, as always, as well as the slides, will be available on our website or upon request by email. So let's get going. First off, these are proposed changes with a capital P for proposed, not yet final, and they're to go into effect the 1st of January for 2014. Now let's talk about timing, where things are in the legislative process. From the 7th through the 11th of October, so basically this week, the Finance or Hacienda Commission of the equivalent of the House of Representatives will be analyzing and voting on all this. The presentation of this package of laws should be the 15th of October to the full House. Theoretically, the 20th of October, the House should approve it. But given that this is the President's first year in office, the rules state that it can go to the 15th of November. I guess due to the learning curve, well, there's a learning curve in all jobs. Now, of course, if they don't comply with these timelines, which by the way, they have complied in previous years, who is going to find them? Answer, no one. So we shall see how it all progresses, and as we know things, we will surely send out a flash informing you of it. Lastly, the following are the main changes. It is not possible in 1 hour and 15 minutes to cover all the specific cases out there. On October 8th, the Mexican president handed the economic package proposal to the Congress, and we highlight the following. There is a new income tax law. There are important modifications to the VAT law. That there are new taxes in the special tax on production and services and to the federal tax code, and the elimination of the flat tax and the tax on cash deposits. Regarding income tax, the interesting thing here is that the full law is being repealed and replaced with a new one. This clears the slate for companies that had won court cases against the government, but it could also offer new opportunities for businesses to claim grievances. The tax authorities will be able to request that foreigners have to prove the existence of double taxation when dealing with operations between related parties, and that you are taking advantage of a tax treaty. Now, these two items, that and the deducting payments when it's 75% of the Mexican income tax rate, these are two of the most important changes. The first is that authorities will be able to request proof that there is double taxation if the Mexican entity applies a tax treaty with a related party. So for example, if the standard rate is 25% withholding for interest, and I will apply the 15% reduced rate per the treaty, then I need to prove upon request, only upon request, that the income is actually taxable in the receiving country. How they would request that and how we would prove it remains to be seen. It seems to be going after the type of hybrid structures where it is interest in Mexico and dividend income in the receiving country and not taxed. So in essence, an abuse of treaty. In our follow-up webinar, once we have the final laws, we will include what would be the best practice to follow here. Secondly, we have a new proposed rule that would make any payment from the Mexican company going to a country not deductible if they're in a low tax country. The problem with it is how they worded it, in that they're not limiting it to the type of income that is passive, such as royalties, interest, etc. So even the purchase of product could be caught in the middle with ridiculous effects. This is one area which, for example, is in the AmCham's position paper on the tax reform, AmCham being the American Chamber of Commerce, and has been quite stressed to the authorities. Individual cases would have to be reviewed and the applicability of the treaty to protect this against this analyzed. Again, to remind you, intense lobbying is taking place and many rules are expected to be changed. Hopefully this will be one of them. Here are a few examples of countries which have a tax rate below 22.5% in 2013, which would be our barrier. Any country below it would create problems for Mexico in having payments. High up on that list, you'll definitely see Switzerland, Singapore, Ireland, and Chile. These are all trading partners that are fairly common in day-to-day business. For example, if I like Chilean wine, which I do, and the winemaker in Chile sets up a subsidiary in Mexico to distribute its wine, the purchase of that wine, their cost of goods sold, would be, according to this, non-deductible. Even if it were market price and everything else about the operation was totally correct. The value of the import at the border, transfer pricing study, contracts, everything's perfect. But just the fact that Chile has a low tax rate apparently is enough to get you into trouble. That is, of course, an aberration and probably not what they were after anyways. And what will end up happening will be a fix either through clarifications in rules, or it would end up being a diplomatic problem in that the tax treaty and any free trade agreements would be being circumvented due to this, which is, well, not really bright. Income tax law. Okay. There's a new 10% tax on dividends. So it's sort of like the capital gains tax. The tax will be final and will not be creditable. It is to be filed at the latest on the 17th of the month following the payment being made on the amount distributed divided to individuals and foreign taxpayers that are corporations. Now, and by not being creditable, we're talking about Mexico. That is to say, it will not be a creditable tax versus your Mexican income tax. So here, the other thing that we would have to analyze is Mexico has many tax treaties, to name one, the U.S., which has a withholding of 5% to be applied if you're a substantial owner of shares. However, the subject of the tax, in this case, it's not a withholding. The payer of the dividends is the subject of the tax. So it would be the corporation. The Mexican corporation is the subject of the tax. And the same would apply to any other country that Mexico has a treaty with. What would have to be analyzed in each individual case is how the tax treaty words everything regarding the dividends, and whether the Mexican government structuring their new law this way is really what is known as a treaty override. So there would definitely be much to do about this. Any company with large retained earnings balance, it would make sense to analyze this to make sure it doesn't affect you. And the first thing would be, well, if I pay 100 worth of dividends or 100 worth of profit and I pay 30 of tax, which is the corporate rate, and then I pay 7 of because I have 70 left over and I pay 7 of dividend tax, all of a sudden now my overall tax related to those profits are 37% and above the 35% in the U.S. And we could enter into being able to credit that tax or the excess. So again, this is an item that is very high up on the priorities of the American Chamber of Commerce in their position paper. And what they're suggesting is leave it at 0 or at maximum 5% so that we won't exceed what's creditable in the U.S. Now, don't jump to the conclusion that the solution is just to declare dividends before year end. It depends how you will finance the working capital of the company after that and many other factors that we would have to address. Deductions. Social Security contributions paid by the employer on behalf of the employee would be considered as non-deductible. This is a typical union type of benefit. Companies with old unions that have been around forever. This is a typical benefit that they negotiate in their collective bargaining agreement. And those type of payments, the withholding, note that Social Security comes in two groups, the employer side and the employee side. And what we're talking about here is the employee side. Some companies would do this, not many anymore, but all employer contributions would be 100% deductible, no problem. Secondly, the deduction limit for the purchase of vehicles would be set at 130,000 pesos. Last year, or this current year, the current law is 175,000 pesos plus VAT. So taking it down to 130 is really ridiculous. It's not that you want to drive a Ferrari, but a regular Honda Accord, which could be typical for a GM, would be around 400,000 pesos or 35,000 US. So definitely exceeding their maximum rate. Now also, the daily deduction limit for vehicle rentals, which this would be an operating lease for a vehicle, is lowered from 250 pesos to 200, kind of to make sense with the lowering. Now, it would be interesting to analyze viability of these type of lease structures to see how much you can make deductible doing it in this way. Secondly, or fourthly in this case, restaurants apparently have no lobby whatsoever because current law has them at 12.5% being deductible, which is pretty much the tip. And that restaurant deduction goes down to 0. Now, this we're talking about entertainment type of expenses in the same city that your employee resides. If we're talking about travel expenses, there would be different limits, but it's nothing to like this. Lastly, wheelchair access investments will still be 100% deductible. Other deductions, and these are major impacts. Food coupons, which are very typical. We like food coupons. We have food coupons. There are two main benefits, extra benefits that we usually recommend, and one of them is food coupons. The other one is savings fund. Food coupons will only be deductible if they're dispersed through electronic cards authorized by the tax authority, and I'll address a bit about that later. Secondly, only 41% of the exempt compensation granted to employees would be deductible, which would include Christmas bonus, overtime, fringe benefits, savings fund. So anything that's not taxable to the employee will be only deductible 41%. And lastly, employers would have to give employees electronic tax receipts for salary payments on the date the payment is made. Now, again, these are major impacts which have been strongly opposed by the main business lobbies such as the Maquila Association and AmCham. By making 59% of fringe benefits non-deductible, they're arguing that with the elimination of the flat tax, if you multiply 30% times 59%, which would be the non-deductible portion, you get 17.7, which is the equivalent of the 17.5% flat tax. What ends up happening is that employers will have to analyze on a case-by-case basis how this impacts you overall, which, shameless plug, we can help you with, of course. Now, does it make sense to restructure your compensation system? Maybe, but it would depend, it would impact the net take-home pay, not to mention Social Security payments, so it depends overall how things look. This can have a large effect in personnel-intense businesses, such as maquiladoras or call centers where your main expense is salaries. So case by case, we would have to analyze it and see how best to structure these. And from the third bullet above, electronic tax receipts for employees. What we're talking about are the famous or infamous CFDIs, the electronic invoices. what is the government looking for? Why is it doing this? The government wants total transparency into what is being withheld to the employees on the off chance someone is withholding and then not handing over that money. If you'll remember, the CFDI type of invoices are issued by the company, stamped by a third party, sent to the government computer, and stamped back. So basically, the government has in real time, when we're talking about sales, your sale operation. So your invoice. They have it in real time, what happened right now. By doing and demanding that employers do that same thing with employees for their withholdings, what they get to is immediate information regarding what has been withheld to whom. So no fudging going on there. Now, we will definitely have to have a specialized webinar to address all of the labor and payroll related changes. Just that, what type of requirements does that electronic tax receipt for salary payments have to have? Now, if you're interested in inviting someone else to this webinar from HR, please forward their contact information and we will make sure to include them on our list. Individuals. And discussing this with many colleagues and with people, for those of you who know Laura Nichols and know she grew up in France, when she heard all about this, she says, well, Mexico needs to learn a bit about France. If these type of proposals had been proposed in France, everyone would have been out on the street protesting and millions of people would have been protesting. And maybe she's right. So not good news here, of course. This, combined with what we will see in VAT, is what has everyone up in arms. The income tax rate would be increased to 32% for individuals who earn over 500,000 pesos, so approximately 40,000 US a year. Personal deductions would be limited to 10% of the total annual income, or the equivalent of 2 annual minimum wages, approximately 47,000 pesos. The limit for the exemption on the sale of houses, so if I have my personal house and sell it, that capital gains previously had a much higher limit, I think it's around 7 million pesos, goes down to 1.2 million, so like $100,000. Tax incentives. Well, there used to be tax incentives, not so much anymore. We had the accelerated write-off of fixed assets. The accelerated write-off of fixed assets would no longer be possible. So we were able to write off a fixed asset in investment, especially if it was outside of Mexico City, Monterrey, Guadalajara, immediately, obviously with a financing discount, but that led to interesting investment. Secondly, real estate development. The possibility to deduct the estimated expenses directly or indirectly related to the cost of a project would no longer be permitted. And thirdly, for real estate developers, it would no longer be possible to deduct the purchase of lands in the year that they were bought. Now, what the OECD had recommended was getting rid of special regimes, of the many special regimes that plague Mexico's tax system. The part the government forgot is that you then reduce the tax rate. With these three changes, they're getting rid of some of the advantages in the tax system for people investing in projects. The fixed assets accelerated depreciation made it very interesting to invest in new property and plant. Real estate is definitely a sector under the gun, it would appear. Of course, there has been a lot of abuse in the sector, but such dramatic actions all at once could leave this area of the economy very weak. Another one, for example, the agricultural simplified regime and other simplified regimes are also being revoked. This you would have expected to hear more about more complaints, but surprisingly, everyone has been pretty quiet. Perhaps it's because the main beneficiaries of these type of agricultural simplified regime programs were big companies instead of the actual farmers. Now, some relative good news here. The EDA tax goes away. And usually I'm all for taxes going away. The issue here is that the EDA tax is the withheld tax on cash deposits. And it only affected taxpayers that collected in cash and didn't file taxes or got balances in favor. Think of my favorite place, Starbucks. All or most of their sales are cash, and they would have the tax withheld by the bank, but credited on their taxes and refunded if need be. So it was really only financing. This ended up being a good way to sock it to the informal sector, which Mexico has a very large informal sector, which studies have shown that Mexico handles a very large amount of cash for the state of development that the economy has, and they get rid of it. So interesting that you would get rid of a tax that nobody thought would accrue much revenue for the government, but did, and that ended up being a tax on the informal sector. And what we'll see overall is that the burden of all these new taxes gets placed on the ordinary suspects of the formal sector. Now, banks will still have to inform the amounts to the government, so the information will still be there and the audits will still be triggered when people are receiving deposits in cash but are not declaring the revenue. Now, some very good news here is the end of the flat tax. So no more scurrying around to pay at the end of the month so as not to generate flat tax. So read my lips, no more flat tax. Now, if this passes come January 1st, there is no transition method, as there would be no tax. So if I haven't collected an AR, and it will never be revenue for flat tax. Of course, that will lead to a whole lot of people passing collections to the following year, but we'll have to see if they tighten up the procedure on the final rules. Now, for companies that have calculated and registered their deferred taxes for financial purposes, and you've registered a deferred flat tax, once the change is approved, we would have to register whatever the deferred income tax calculation gives us rather than the deferred flat tax. Now, this could lead to some very interesting swings for companies that had losses, for example. Also, as a note, before we get into value-added tax, there are new taxes for the mining industry, which can be quite substantial. Now, following are the general impacts for the tax reform for value-added tax. And if you're a maquila company and you don't see your case here, don't worry, we'll be covering it in a special section a bit later on. Now, these are some of the most controversial proposals and likely not to pass. The VAT rate would be set at 16% in the border regions. The current rate is 11%, so someone in Tijuana pays 11 instead of 16 to be competitive with California, which I don't remember how much it has, 8%. If it went to 16, it would be double California's sales tax rate. So in order to be competitive, the border regions have always said we need to have a competitive sales tax rate. Secondly, the VAT exemption on the purchase, rent, and loan payments, interest, and commissions on houses would be eliminated. This is huge. The applicable rate would be 16%. That doesn't happen in other countries. 16% tax, value-added tax on the sale of a house is massive. You don't see that in other countries, and hopefully, and that's like these three have been part of the three most opposed items. We're hoping will be the rough edges that they get rid of. private education for schooling would no longer be exempt, and the applicable rate for tuition fees would be 16%. And I would go along with that perfectly if they would make it deductible for the formal sector, which they wouldn't. Now, all of these hits are pretty large, and they're hitting the formal sector. Now, there's been mass discussed with all these proposals, and we will have to see how it pans out. VAT on missing goods in the inventory and donations. Regarding missing inventory, the tax will be paid when the taxpayer or the tax authorities recognize the fact, whichever happens first. Well, this is the criteria we have always had, and it's basically to clarify for people that try to not accrue the value-added tax. And in case of donations, when a donation made by a company are considered as sales for VAT purposes when the donation is non-deductible for income tax purposes. And this would be new, and it's likely to avoid some tax planning that someone had going on. The special tax on production and services law. Now, here we have two new taxes, and I'm really only going to talk about one of them, which is the sale and import of pesticides would be taxed at a rate ranging from 6 to 9%, depending on the degree of the toxicity. And secondly, the sale and import of fossil fuels would be taxed according to its carbon contents. Now, regarding the pesticides, and if anyone sells something that could be interpreted as some type of herbicide, pesticide, insecticide, the actual definition and whether it qualifies would have to be analyzed. The interesting thing here, of course, is it's another hit against the agricultural sector. They just got rid of the simplified regime. Now we have a special tax, and a lot of this you can see who the authors are. The Green Party, which is part of the president's coalition type of deal, is the Green Party, and so they would want to tax something like that. Now, this one I'm not against. For a country that has many obese people, we're beating out the U.S. in this competition. A 1 peso per liter tax would be charged on sweet soft drinks, concentrated powders, syrup, essence, or extract flavors. So that would include your Hershey Milks or whatever is sweet, I guess. And a 1 peso tax, which can be quite substantial. Now, in the federal tax code, we have many items that people haven't really been focusing on. Obviously, the big headlines go to the value-added tax and the personal deductions and the house sales and all that. But a lot of the real impact happens in the federal tax code. So we'll have to see. And in my view, when some of this, if we think it's going to get watered down, it will likely not get watered down in regards to the federal tax code. So many countries have a general anti-abuse clause that limits tax planning. The U.S., for example, has the sham transaction doctrine. Mexico is catching up to world standards in this regard. So if there's no substance to an operation, the authorities will be able to recharacterize it. Now, it remains to be seen how this would be applied in practice, but it's a pretty big stick for the government. From now on, in all planning and structuring our operations, we will have to take this into consideration. Federal tax code, the buzón tributario, the tax mailbox. The tax mailbox will be an electronic communication system called the buzón tributario. So if you see that on your invoices, don't worry. and it would be created to allow communication between the taxpayers and authorities in a secure format, kind of like a portal. Taxpayers will be notified regarding various documents and administrative acts and will be allowed to file letters, requests, notifications, or fulfill authority requirements or requests through electronic or digitalized documents. The taxpayers will be able to consult their tax situations and resort to authority acts, which will facilitate fulfilling tax obligations, or so they tell us. Notifications regarding refund requirements will also be done through the system. Now, it is specified that a taxpayer will be considered as notified within 3 days of the information being sent to the Buzón Tributario. Now, the rules on how this mailbox will work are not quite clear yet, but it will serve as a means of communication with the authority for requests of additional information. We'll have to expand on this further on our following webcast once the final changes are out. But the essence of why this is happening is due to the government losing many cases through technicalities on how the taxpayer was served. This eliminates that. The legal rep signs the original registration and after that is considered to be properly served by electronic means. One important thing to note, and we will likely expand on this further, is that the email that will be registered should be a group email in that it goes to the legal rep and at least 2 or 3 other people. This so that if the legal rep is on vacation in the middle of nowhere, he or she won't be checking email, or you could get into situations where it goes directly into your spam filter, and then boy are you in trouble. Now, setting up a proper procedure will be the name of the game here. A lot of this goes in line with what Mexico has been trying to do to make their tax collection more automated and efficient, less subject to fraud, which is trying to make everything go digital. And that's fine, but there are places in Mexico which are not Avenue Presidente Mazarik in Mexico City, which is Mexico City's Rodeo Drive. There are places in Mexico that yes, people have a Facebook page, yes, they have access to internet, but it's not the same degree of sophistication. So making this obligatory for everyone seems a bit far-fetched. The statutory tax audit, Mexico has had the obligation to have a tax audit by a third-party audit firm, such as one of the big four, for many, many years. And it was strange in this regard. And the OECD had always told Mexico, you know what, you have to get rid of this obligation. It creates added costs for companies. Now, since 2010, it has been optional for companies to opt out of the obligation to do their audit, which is the CPRED, and file optional information, which was called a CPIAD. Now the government would be getting rid of their requirement altogether. So now only companies that want to audit their financials for financial purposes, be it bank loans, SEC, or other stock market requirements, or shareholder requirements, would be obligated. The next item would be large corporate taxpayers would have to file an informative return regarding their tax situation at the latest on June 30th of the following year. Those large taxpayers would be those above 650 million pesos in revenue, I believe, for the previous year. So around $58 million, more or less, would have to file the additional information. Thirdly, companies that deal with foreign taxpayers will also file an informative return. Joint liability. So here in the federal tax code, partner and shareholder liability limits regarding omitted contributions, so not paying your taxes, would be modified and would be considered to be up to the percentage that represents their shares in the entity. So if I had a company previously, and many dodgy companies would do try to apply things like this. If I had a company with capital of 3,000 pesos or $300, and I had 99% of that capital, and there was a 10 million peso liability for tax purposes, I would walk away from it and say, well, I as a shareholder will contribute up to my capital because of the corporate veil. What this would be doing is getting rid of the corporate veil, piercing it for tax-related items for the Mexican entity. Now, our type of client always pays their taxes, so it really isn't an issue for us. But it would remain to be seen how the government would apply this if the shareholders of foreign entities. Would foreign law take precedent, or not? So, obviously many interesting things to come. Digital stamp certificates. The authorities would have the ability to cancel the certificates and thus prevent issuing invoices when a taxpayer issues invoices and does one of the three following things. Omits to file 3 or more consecutive returns or 6 non-consecutive ones, cannot be located, and issues invoices for a non-existent, simulated, or illegal operation. Trying to stamp out the practice of false invoices, the government is setting the conditions in which they can revoke your digital seal. Now, as a reminder, as of 1st of January 2014, all taxpayers will have to migrate to CFDI invoices. These are electronic invoices that are stamped, and we're talking about your sales right now. So your revenue, how you prove your revenue, how you send your invoices to the clients. These are electronic invoices that are stamped by a third party and the government before being valid. Previously, many companies that migrated before the CFDI rules took place were able to apply the CFD, which instead of the invoice going to the government and a third party and coming back, the company could do it by themselves, issue an invoice, and would only have to report what their operations were at the end of the month in an informative filing. With this, all those companies that made investments in the CFD will now have to update to CFDI. This is definitely something that you don't want to start working on December 20th. So it's something you should start working on now. Actually, we're recommending our clients to try to do transition and have 30th of November be your last day where you issue a CFD, if that's your case. Now, more information on this was mentioned in our bulletin of June 2013, and it's available on our website or upon request. And any questions you have, please let us know. The important thing and the takeaway here is to be up to date on your filings so that your invoicing valve is not shut down. If your invoicing valve is shut down, you pretty much cannot sell. Now, regarding the second point of online accounting system. An online accounting system would be implemented and its use would be mandatory for individuals. Now, legal entities, so companies, would have to provide their accounting information on a monthly basis through the tax authority's website. Now, the law states that they would input their accounting information into the government systems. Rules to follow, and that's basically the extent of the article. Rules to follow. So what in the world that means, no one knows. It would definitely be interesting to think of GM Mexico putting their accounting online for the tax authorities and everyone else as well. There isn't enough bandwidth, storage space, etc. to fill that. Mexico would end up eating half the world's resources for bandwidth and storage if that happened. So it's not going to happen. What might happen is that the government adds some type of informative return on a monthly basis, depending on revenue levels, and standardize a chart of accounts of sorts. What this would end up obligating you to do is always be up to date on your accounting. Theoretically, no more adjustments after the fact. Of course, we will have to see if the system does allow adjustments for prior periods. What if I'm being audited by my audit firm and we come up with the tax accrual? That should go in the year that it's done. I can't necessarily have that available perfect by the time you close out. That's what adjustments are for, and you would think the government would understand that. Well, this warrants a talk all on its own, the maquiladora industry. And we will be contacting our clients directly to address the way the proposed changes affect companies. The Maquila Association in Mexico, known as the Index, is up in arms and is a very powerful lobby. I would say it's probably the most powerful lobby in Mexico as a business lobby because it's highly concentrated. And it's likely that the rules as proposed will not, again, repeat, will not be final. We do not recommend changing your operation until the new rules are out and we have more certainty. One item will be that the decree that reduces the maquiladora's tax rate for safe harbor would no longer be valid for the 2014 year. So that calculation, which reduced your 6.9% to 3% of your assets or 3% of your expenses and basically halved your tax burden, would be gone as of 2014 calendar year. It would still be valid, of course, for 2013 calendar year. Now, a new definition of what a maquila is for income tax purposes is included in the text of the income tax law. And it establishes the following: that maquiladora companies must export at least 90% of their total annual invoices, merchandise provided by the resident abroad, the foreign taxpayer, and whenever I say foreign, I'm looking at it from the point of view of Mexico. So it's Mexico, who's foreign? Merchandise provided by the resident abroad must be imported temporarily and returned abroad. In the case of national product or definitive imports, these must always be exported. Thirdly, the transformation or reparation processes carried out must be done using machinery and equipment which is owned by the foreign resident and with whom a maquila contract has been signed. And the goods must not have been the property of the maquiladora company or any other related party resident in Mexico. Now, why is the government after these maquiladoras, and what are they trying to do? They're trying to cut down on companies that are abusing the program in the current rules in order to have the income tax benefits of not having PE and being able to take one of the transfer pricing options the government is defining. Now, 90% of the revenue, we would be talking about the Mexican entity. So it's 90% of my sales, be it maquila service or whatever I invoice out of the Mexican company, the maquila company. Now, this can be an issue for companies that deal both in the export maquila market and also sell domestically. The important thing will be if virtual exports of product from a maquila company to another maquila company will count in order to not lose the benefits. As it is worded now, they wouldn't. This is one of the main issues the association is pushing, as it would severely affect the way supply chains work. Now, the idea is to attack companies, in the third point, the idea is to attack companies that were previously Mexican manufacturers. They were not your typical maquila companies, and that they transform themselves into a maquila company, but in essence aren't your typical maquila company. However, with these rules, it would seem the government wants us to go back to 1980 when maquiladoras were much simpler and supply chains were much shorter. Now, for the tax profit calculation of maquiladoras, there are currently 4 options, and it's we're talking about transfer pricing here. So we already talked about permanent establishment, which exempts me from having the foreign corporation have a presence in Mexico. And the other item is, how do I comply with the transfer pricing for my service? The tax profit would have to be determined by using the safe harbor method, which would mean the 6.9 on assets or 6.5 on costs and expenses, whichever is highest, or through an APA or advanced pricing agreement. by which the authorities grant a resolution. Using a transfer pricing study would no longer be an option. And using the transfer pricing study plus 1% would no longer be an option. So this can affect companies that have very large investments in fixed assets quite intensely. Now, once we have final rules again, we'll have to address. However, it does make sense to start thinking through, as if the new laws go to the maximum deadline of 15th of November, time for reaction could be short if the new law will apply 1st of January, which it surely will. Now, regarding the value-added tax, this is a huge change. For companies currently importing without the VAT exemption on temporarily imported merchandise would be eliminated. So if I currently am a maquiladora company, I import my product and I do not pay value-added tax at the border. And once I transfer it over to my client, who can be the person or the company that will then add value to it and be the end exporter, or it can be one of a chain and I may be 5 steps away from it being exported. But currently, that's the way the rules work. I import, no VAT. I transfer it, no VAT. It gets transferred again, no VAT, all the way along the chain until it gets exported out of the country. If at some point part of that production doesn't get exported out of the country, then that company who's ever left holding the hot potato would have to pay the value-added tax. Now, with this, companies would have to shell out at the border and wait for a refund. And that can be a huge financial cost. It's actually estimated to be around 22 billion, with a B, US dollars by the maquila industry. Now, it is only financing, but the government will have to improve its turnaround on refunds and perhaps go back to the days of the 5-day refund for maquila companies. The next item is that the VAT paid for the introduction of these type of goods, the way the rule is structured, and it's not clear, and there are many different opinions, the VAT will be creditable once the merchandise is exported, and refunds will be able to be requested. Now, that sounds simple, but it's not. What happens, imagine if I import screws, and I import 1 million screws on one import document. And I pay now the value-added tax at the border. And I transfer over to my client, who then, and I transfer over to 5 different clients. All of a sudden, now I'll have to track what VAT has been paid regarding what screws. So you get to absurd situations. Now, one item that is floating around as a possibility is that certified maquiladoras, which are, say, the 200 largest, they are the big OEMs, the contract manufacturers, could potentially be permitted not to pay the value-added tax at the border and on transfers. However, this would still leave everyone else in the supply chain pending. And with margins tight, whatever affects the big anchor OEMs and contract manufacturers will end up affecting them. So if there's a financial cost, at some point, the end client ends up bearing it. Now, in order to reduce these type of financial costs and avoid cash flow issues, the federal government has said it will create programs to establish financing. I would very much like to see that. I severely doubt that it would be easy for the government to say, I'm going to lend money to all these foreign companies so that they can pay me my taxes. It just doesn't sound politically feasible. So we'll have to see how this all turns out. Now, the next item, and this again is mind-boggling, is that the tax exemption on the sale of goods between residents abroad or between a resident abroad and a maquiladora company is contemplated on being eliminated. And the obligation to withhold VAT on domestic suppliers that have an EMIX program would also be eliminated. Now, that is taxed on sales. That is taxed on sales that have material delivery take place in Mexico regardless of who the owner or client is. So if I'm a company, and I'm let's say a US or an Italian company, and I own product that's in Mexico in my maquila program of my subsidiary, and I sell that to, for example, Flextronics Singapore, the way the rules are currently, that sale is exempt because it's happening between two maquila programs, between my maquila program, ABC Company, and it's being transferred over to Flextronics. Taxing that sale would be insane, and it would totally kill the whole model. So it is likely that this will all be reinstated. Now, in a nutshell, I think companies that are in the supply chain and either transform or don't their products, but they transfer it on to someone else who then exports it, such as an auto company, or companies that provide a service, we will end up having to analyze them on a case-by-case basis. Now, the million-dollar question, and before we get on to questions and answers, is how much of this, if anything, will pass? Now, regrettably, it is much up in the air. The president's party is behind it. The PAN, the more right-wing business-friendly, is apparently against it. Over the weekend, they were handing out flyers all over the place, trying to win approval for their plan against it. And the PRD, which is the other more left-leaning party, is against part of it. However, this all ties back to the petro reform sector, so oil. This all has to do with oil. So we'll have to see if the idea the government has was, okay, we'll pass a pretty aggressive tax reform. In exchange, we'll get some major progress on oil sector. Well, we would have to analyze the net benefit for the overall economy, tying in everything. Now, I can predict it will not pass in its current form because there is just so much opposition, and it will have significant surgery done to it. But my view is perhaps that 70% of it would pass. Maybe they would get rid of the roughest edges, but again, that's my projection, and we'll see how good I am on it. Let's see what happens. Now, we have, and I think we're a little ahead of schedule actually, so we're available for questions and answers. Now, okay. The first question I have is, what happens with the tax credits I had regarding flat tax that were pending to be applied as of 31st December 2013? Now, if you will remember, the tax credits, if I had salary credits or any other type of, if I paid Social Security, then I get a credit against my flat tax. That's an advantage that I have, and there is no transition mechanism. Now, the thing to remember is that that credit is only good against flat tax. If there is no more flat tax, it's really not much good. Another question regarding maquiladoras. What happens if I'm a service company, logistics, and I transfer over to another maquiladora company? Well, as I mentioned, the important thing will be to analyze if I have if I'm importing, and first of all I will start to get hit with value-added tax when I import. There, the effect, if I'm in the supply chain, the risk is that, and it's part of what I'm worried about, is that the government isn't looking to get the value-added tax so much, but it wants to concentrate on the income tax. Because what ends up happening if I'm in the supply chain and I'm not the one doing the direct export, would I have to transform my operation where Mexico ends up being distribution? And that can be the case, for example, in companies where you have a mixed operation and you won't get to that 90%. Now that 90% will happen when, like that 90% and complying with all the rules will give me benefits according to the income tax law, which are the permanent establishment exemption and being able to apply the transfer pricing. So there are also benefits on the value-added tax side, which should not be changed. But again, they would have to be analyzed on a case-by-case basis. We have what happens to machinery already imported VAT-free under EMIX. Will that be changed? There hasn't been much of a transition method, and that's actually machinery is an interesting case, because machinery, if we import new machinery, the way the proposed rules are, there is no credit mechanism, because the rule that they're putting is that when it's exported, I'm not importing a machine to export it, I'm importing it to have it be inside my program. So we would have to see, I'm very sure that the rules regarding machinery would be changed. So I think we'd have to look to see what the new rules are. Now, besides the elimination of the YETU, is there any real practical benefit for the country? Well, this is not the tax package that I would have written, but they didn't ask my opinion. So does it stimulate the economy? Probably not. They're going after the same old subjects. So I guess the answer would be the idea, and part of what I didn't mention, for example, is that they're putting into place two new regimes where there's a pension for old age people, so more senior citizens, and for the unemployed. So part of this is to pay for that. So it depends on what side of the item. Now, we have another one, temporarily imported fixed assets will be subject to Mexican VAT. Correct, as the proposed rules are. So import duties, all the other advantages regarding maquila companies, and that's an interesting point. Perhaps I'll be obligated to pay value-added tax at the border, but I still get the advantage, and I would get that back when I export my inventory, for example. But the import duties, like actual duties, not VAT, my maquila program should continue to protect me. So there can be cases, especially when it's non-NAFTA or free trade related, where a maquila program will still be an advantage. Now, most taxes would be detrimental to the agricultural industry. Are there any favorable proposals for this industry to report? Not that I can find, so we'll look through them and see if we can find something. It doesn't seem to be any favorable things for any industry in particular. So since they're getting rid of any type of tax benefits, it's more like just getting rid of stimulus. Now, I'm seeing a trend here. I'm getting a lot of complaints, and remember that I'm just the messenger, and these are proposed laws, and we hope and pray that they will be addressed and amended so that we don't have the hardest items impact us. Should these laws go into effect, do you think this will cause small businesses to close or companies to withdraw from Mexico? I think it depends on how the final language ends up. Like there are items here which, if not changed, would definitely make companies go away. But I think the impact is too severe for them to consider it. I think if they left the maquila industry, for example, without any support whatsoever, with so many hits, then definitely companies will leave. The maquila industry employs something like 2.3 or 2.4 million people directly, so I severely doubt that the government wants to leave that many people, direct employees, and 7 million indirect, without jobs. So I'm sure if some of this takes place and it starts affecting people substantially, they would hurry up and issue new rulings that would make things a bit softer. Now, if I have yet to in favor at the end of the year, if my annual calculation says that I overpaid yet to, then that yet to, which would not be possible because it's accumulated, but whatever your end yet to or flat tax is, that would be the end flat tax. Well, if there are no further questions, we do thank you for attending our webcast, and I know a lot of this is a shock, and many questions will pop up once you start digesting it. The material will be available upon request, and will be on our website. And we do thank you for attending our webcast and hope it has been informative. Hope we didn't ruin anyone's lunch. Now, if there are any questions, well, please do not hesitate to contact us. Thank you very much.